No two recessions are the same. But we've never seen a recession like 2022. It already has some traditional signs of economic slowings, such as a decline in GDP over the past 2 quarters, and such sign is the textbook definition of a recession. In this video, we will be going over what a recession is, who declares the recession, and how to grab the opportunity disguised as a pandemic, since statistics have it that most of the successful businesses you know were created during the recession, including Amazon and Uber. What is a recession? The National Bureau of Economic Research defines a recession as the significant decline in economic activity that is spread across the economy and that lasts more than a few months. I know you have heard that countless times, and might still not get the meaning, but let's dive in deeper. During a recession, the country's GDP declines by 2% and in some serious cases up to 5%. Investment, imports, and industrial production also drop. This drop negatively affects the population, which can cause loss of jobs, and if they can't afford their mortgages they might lose their homes too, which in turn makes the house prices drop. They also don't have money to spend in restaurants and shops, which means businesses may go bankrupt. Now that we know the meaning, let's talk about who declares the recession. Officially, it is the Business Cycle Dating Committee of the National Bureau of Economic Research, or NBER for short, that declares a recession. Now you might ask again, why haven't they declared the recession yet, since there is already a decline in GDP over the past 2 quarters? Well, this is because there are other factors like consumer buying confidence and industrial production, which have to be declining too before a recession can be declared, but as of the time of making this video, these factors and other factors like house prices are still on the rise. Now comes the final question: how do I take advantage of the recession? Please note that I am not a financial advisor, and these are just my opinion based on what has worked over the last few recessions. Now let's get started. Number 1. Lower your average cost. It's never pleasant to see your brokerage statements at a time like this. But don't worry, this is a great buying opportunity for investors in the long term. For example, if you bought $5,000 worth of a stock that is priced at $100 per share, and it drops to $80, you can buy an additional $1,000 worth of that stock, and this will bring your average cost to $90 per share. Not only will it be easier for you to break even, but a return to your previous purchase price of $100 will now result in profits, rather than simply breaking even. Number 2. Pick up cheap dividends. When stock prices fall, their dividend yields increase. For instance, if a stock trades at $100 and yields 2%, that same stock will yield 4% if the price falls to $50. That's twice as much income for shareholders who buy at a lower price. You'll have to be a bit careful here, as some stocks that lose half of their value have business issues that could result in a dividend cut. But if a high-quality company sees its share price fall simply due to negative overall market sentiment, it's a great way to pick up a big income stream at a cheap price. Number 3. Buy index funds. Investors have tried to avoid the markets in bear periods and rather invest their money in mutual funds. However, as the economy bounces back, that's not always an effective strategy. Historically speaking, the market indexes have always recovered and made new highs after a bear market, and while you may see greater returns with individual stocks, investing in an index fund is typically less risky. Number 4. Boost your emergency savings. The Federal Reserve typically increases interest rates during recessions to combat inflation and later on decrease it during the end of a recession. Savings account interest rates can often be dramatically higher during periods of low economic growth. Let's take Marcus Online Banking for example. In 2020, their interest rate was at 0.5%, but by 2022 it was up to 1.7%, and this may go up higher as the Fed continues its battle against inflation. That's why it is a good idea to pour a lot of money into your emergency funds and to take advantage of the high interest rate. Number 5. Wait for lower interest rates. Just like in the early stages of a recession, people can take advantage of better rates if they want their money to work for them. In this situation, the government has begun lowering interest rates at the end of a recession. Historically, the market has seen some very low rates like with the recession triggered by the coronavirus. However, this was an unusual case, and because of it, the Federal Reserve responded by decreasing its federal funds interest rate to near nil, which pushed mortgage rates down to an all-time low of 2.65%, offering a great opportunity for both investors and first-time homebuyers. Rates won't always drop that low, but chances that you can manage to get something below current levels may be pretty good coming out of the next recession. And there you have it, those are my 5 tips on how to take advantage of the recession, and just before you leave, I have a bonus tip. which is to start a side hustle. You see, this YouTube channel was motivated by the recession, and you too can start any side business of your choice, and also be consistent on any side business you start. If you are interested in learning more financial terms, please subscribe to my channel and also, leave a like on the video if you understood the term recession more with the help of this video. You are awesome, and I will catch you in the next one.